Hello and good afternoon, everyone. How are you today? Welcome to our webinar for today's session discussing the topic international trade. My name is Hiba Abbasi, and on behalf of the University of Manchester Middle East Center team, I would like to welcome you all and thank you for taking the time to join us. Today, I'm very delighted to be joined by one of our senior alumni, Dr. Bhaskar Dasgupta. Dr. Bhaskar is the Associate Director of Business Development at Abu Dhabi Global Market, focusing on financial services across emerging markets and Europe. Dr. Dasgupta is responsible for overseeing the development of the banking, asset management, private banking sectors, including key areas such as crypto assets, FinTech, reinsurance, sustainable finance, digital banking, and digital investment management in Abu Dhabi Global Market. Prior to joining ADGM in 2019, Dr. Bhaskar was the Chief Operating Officer of UK Expert Finance at the Department of International Trade, UK government. His 25-year career included senior-level business development and transformation roles in investment banking, transaction banking, technology, and consulting in firms such as HSBC, ABN AMRO, Citigroup, and PwC or PricewaterhouseCoopers. Dr. Bhaskar holds a Bachelor in Science in Mathematics from the University of Bhopal and an MBA in Finance from Indore University, a PhD in Financial Modeling and Artificial Intelligence from the University of Manchester, and a PhD in Politics from King's College London. He is currently completing a third PhD in food history from Brunel University. Dr. Bhaskar, it's a pleasure to have you with us today. And before we start the session, I'd just like to tell you about some ground housekeeping rules. You're all going to be muted just to eliminate noise. And we will be taking the questions toward the end of the session. So if you have any question that you would like to ask Dr. Bhaskar, please type it in the questions box or in the chat box, and we will get to it at the end of the session. This session is also recorded, and we will share it with you tomorrow, hopefully with the slides. Dr. Bhaskar, welcome to our webinar today. And my first question is actually revolving this current situation, COVID-19. And we've seen that every single aspect of the economy has been impacted severely, including supply and demand, and of course, international trade. What will the future of international trade look like? And what are some of the options for financial institutions and corporates to take into consideration?
Okay, great. Hiba, thank you very much for that very warm welcome. And hello to everybody who's joined us. I can see family, I can see friends, and I can see friends who I haven't met before. So a very warm welcome and hello from Abu Dhabi. So thank you, Hiba, for that great introduction. And let me see if I can spend some time in trying to answer your question. I'll be talking mostly about international trade and what I'm seeing from both the supply side as well as the demand side. Also, some views on what may or may not happen and some options. I should point out that these are purely my personal opinions and are definitely not representative of my current or my previous employers. I need to say that. So please feel free to blame me if I go off piste and talk rubbish. Other than that, let's get cracking. Right. So the first thing is about where do we start from? Because if you're trying to describe what's happening right now, you need to have a bit of an idea about where we're starting from. So historically, if you wanted to see the state of international trade, you start from the post-World War II status or the starting point. And as we all know, a huge growth in the world economy and international trade happened. It was generally higher than the great growth of GDP. Why? Information and communication costs dropped quite a lot. Technological change happened, and what that did was that it fragmented the production supply chain so that you could start picking up bits and making it much more efficient to produce that bit of the supply chain in another place, and it became much more efficient, because if you try and manufacture or produce your service everything in one place, it might not be that efficient. Plus, people started to get a bit less hung up on the Westphalian nation-state strong borders and make everything yourself construct. And LATAM, Eastern Europe, Middle East, Asia, they all started to get much more integrated. International cooperation started, GATT, and then the WTO started to come into being. Of course, the big thing that happened was that China got integrated into the WTO. And of course, the industrial supply chain extended and embedded deeply. So people became much more efficient throughout the supply chain and across the various markets, which obviously meant that international trade absolutely boomed. And I know I'm taking a huge jump, but if we jump forward to the global financial crisis of 2008, which is, I guess, the last major turning point that we had prior to the current situation, the global financial crisis did change quite a lot. And I have to admit that people are still debating as to why that happened. For that matter, I mean, people are still debating why the Great Depression of the 1930s happened. So I think we've got another century to go before we'll have some definitive answers as to why GFC 2008 happened. But it actually did change the underlying trade dynamics fundamentally. A few things that I think the reason why what it did was, first is the demand for durable and investment goods kind of plateaued. It's never really picked up at the rate of growth we were seeing before 2008. Also, because of that, one of the key drivers for economic growth and trade, which is corporate investments, that has stayed low since 2008. Also, because of regulatory aspects, we have seen the traditional form of trade financing, that is from the banking sector, that has shrunk. Especially the SME sector has seen a relatively big hit on availability of trade finance. Another factor that has come in is what I call as the peak stuff theory, that you tend to start seeing that as and how the populations are becoming richer and richer, they are moving up the prosperity curve, the need for people to buy large ticket items is reducing. Whether we're talking about refrigerators or whether we are talking about suitcases, etc., etc. Once you have bought them, they tend to stick around for a long time. So the chances of you needing to buy another one becomes lower and lower and lower. So as and how most of the world's population is moving into the middle class territory, you start seeing the amount of big ticket item spending on the consumer as well as the investment goods slightly reducing. So that's what I mean by the peak stuff theory. Increase in sharing economy. So instead of you needing to buy everything, you can start sharing it. One of the common examples that I give is of people who started to share suitcases, especially in urban areas where space is limited. Why should you have 3, 4, 5 suitcases in your home when you can just hire them? Now that's all very fine for the consumer, but in terms of purchases of suitcases, that drops, and you can just extend this across to other places as well. Then one of the corollaries of what I talked about on the good side is that people have started to do or have more benefit coming from services and online consumption rather than goods. So that's obviously going to have a bit of a different impact on consumption and demand. The Chinese economy is rebalancing as well. Aside from previously the export-oriented growth that it had, the Chinese economy is now starting to push more for internal demand. So that's also impacting international trade quite a lot. One more argument that has been made is that the fragmentation of production and supply chain, I think we have done as much as we could. And now there are just diminishing returns to how much you can slice the production and supply chain. Protectionism is definitely rising, and we have seen that happening quite a lot. And in several regions, you have seen that the countries think that they have been overbanked, and deleveraging is happening. So the amount of credit that is available in those markets, that is reducing. So this is what we had. Yes, things were improving a bit, but this is what we had as we went into the COVID-19 status. So what do we have? As I already mentioned, we still don't know what happened with the Great Depression of the 1930s. So this is very early. But some of the things that you can actually identify based upon what we can see at this moment are there's a demand shock across most sectors. And what I mean by a demand shock is, of course, the things like travel and transportation, et cetera, that is dropping hugely because, well, it's locked down. And so people are simply not going to travel. But generally, people have stopped buying stuff. The same thing for individuals, households, corporates, as well as governments across all the sectors. That is definitely there. And because of the economy is shutting down, the supply shock has also come through. Production is simply not happening. And this is fairly unique. It is very, very rare that you see demand and supply shocks globally across most of the sectors. At least I can't think of any other situation or time in history that something like this is happening. The next thing that we have seen is a huge amount of debt financing that has increased. Just last week, I think there was an estimate that up till now, various governments just on the OECD side, and once you add in the others, you're looking at 20, maybe 30, $25 trillion of debt financing that has gone in. But the interesting thing is that the fixed income markets haven't complained. In fact, as I mentioned later on, you're starting to see negative interest rates popping up in strange economies, in places that you wouldn't expect, like the UK. Then number 4, sharp rise in unemployment, uncertainty factors about the future outcome is increasing quite a lot. The inexplicable rise in equity markets is there. Yes, you can talk about the fact that it might be because people are comfortable that the central banks and the governments will do whatever it takes for the economy to recover, or perhaps they are assuming a V-shaped recovery. Be that as it may, the equity markets broadly are, yes, highly volatile, but are showing quite a lot upside. So we don't know. And finally, this isn't actually a recession. Recession is when you have 2 succeeding quarters of dodgy growth. This is the economic shutdown. And the few examples that we have historically of how economies have reacted after shutdown, a few things happen is that it's very difficult to restart economies in a neat way. It's much easier to shut them down rather than to start them up, because naturally the supply chains are extended across countries. The various sectors start at different times. The factors of production, like people especially, they find it difficult to come back. They might have gone back somewhere. They might be stuck somewhere, et cetera, et cetera. So when the economy does come up, it's going to come up in different ways. So let's talk about what are the scenarios that might happen. And I think I'm going to use the scenarios as shown by ING Bank, because I felt it was a fairly good example of the 4 scenarios that you have got. And please don't worry about the numbers. Hiba has promised that she's going to share the presentation after this, so you'll be able to get hold of the numbers, and that also has the links in there. So this is the base case, and the base case includes the full lockdowns end by summer. Global travel is restrictive, home working is in place, social distancing remains. Winter outbreaks may well happen, but it's more manageable. But when you're looking at what's going to be the impact, you'll see that there is going to be a fairly substantial impact in the second quarter, whether you're talking about the US, Eurozone, China, or the UK. So that's the base case scenario that we're looking at. The second is that we see that the second wave, as we have seen in the 1919 Spanish flu influenza, the second wave was much stronger than the first wave. And if that happens, then you will see that the second quarter and the fourth quarter is going to take a further hit. And this is all about the winter lockdown. And as you know, the broader case of flu is always active during that time. COVID is going to just add to that and obviously create a bigger issue than what we had imagined. So that's the second case of winter lockdown. Then this is obviously the best case, which is we don't have further waves, or it's manageable, much more manageable. By summer end, we finish everything, and so we have a short, sharp sort of close down or a shutdown in Q2, and from Q3 onwards, we start seeing sort of a V-shaped, and as the numbers show, from Q3 onwards, you start seeing a burst of activity. And then, yes, there's going to be a longer term implication, definitely, but this is obviously the best case scenario. And the last one is absolutely the worst case scenario, where you have lockdowns that stay on till year end. You have global travel that is highly restricted. Home working is there. Social distancing is again there for the next 18 months. Wave 2 hits and hits quite badly. Testing is not possible. Vaccine is going to be a challenge, and that obviously is the worst case scenario. And as you can see, basically you are giving up on any kind of good activity happening, any upside in the economics this year. So that's the situation. So those are the 4 options that ING Bank have laid out. So the question comes, obviously, what are my thoughts? And I just thought that let's bring in something that is from my childhood, from Asterix. So of course we've got vital statistics, who keeps on saying that the sky will be falling on our head. Now this may be that if you are a pessimist long enough, then what you are afraid of and have been warning, that does come true. But I do think that we are going to have a bit of a challenging time. The key aspect that's going to come in is the situation around vaccine. And as you know, some of the guidance that we have been getting from the WHO or even what was reported in the Financial Times last week, to have a good COVID vaccine come up soon is very, very optimistic. And I was speaking to a friend in Dubai, and she was mentioning this is also predicated on COVID-19 not mutating, and we are already started to see strains coming up. So I would err on the side of caution, saying that even though we have a successful vaccine, and where a lot of countries are having multiple different ways of coming up with different vaccines, which is a good thing, even if they start coming out and clinical trials have done and they are understanding of what I would call as the side effects, which can be horrendous in certain cases, you're looking at next year before these vaccines start getting deployed out generically, and can take quite a long time. But as we have seen from the flu vaccine, it's not a panacea. It's not going to just fix it like that. Think about how long it took for us to come up with a solution for AIDS, decades. So we should be prepared for what I would call as a possibly a more realistic scenario of next year, that the vaccine comes. I'm not an expert on epidemiology or virology, so whether or not herd immunity will work, but given the fact that majority of the deaths and the infections are for what I would call our senior citizens, it's a tough decision to take. So that's what we are talking about. So in terms of the cases, I would say I would look at expecting that economic activity is going to be subdued this year, and perhaps a realistic scenario would be that we're going to start seeing an uptick next year. But that's all dependent upon on how the vaccine progress is reported. So given that, the question that comes up is, what are the factors for the future of international trade that we need to think about? So as I mentioned, the demand is going to be subdued quite a lot. Of course, the unemployment situation is going to be a dampener, and because we just don't know what the future is going to be, therefore the risk aversion is going to be high. My suspicion is that demand is going to be subdued for rest of the year, and possibly even well into 2021. And in certain cases and for certain sectors, the demand might not come back at all. It's, for example, if we are not able to really address it properly, then possibly the senior citizens might not decide to fly. Is one example that I keep on giving. And the resolution of employment will also take years to come back. People have started to work from home. The structure of the economy is definitely going to change. So automation definitely could rise. The way we work is definitely going to change. So we should be aware that the issue around unemployment is going to take long. And I'll come to a few other aspects relating to unemployment in a moment. The supply shocks will definitely ease. It's relatively easy for the supply side to come back into operation. So I do expect that to open up. Economies are starting to open up. Next month, I think we should start seeing a significant rise in economic activity and open shops, etc., etc. Reshoring will definitely happen, because I do think that people are going to relook at their supply chains, not just from the perspective of efficiency as measured by cost or by time, but also by risk. There's also quite a lot of murmuring in the political side about trying to increase the security of supply, and that in many industries and sectors will play a higher role, perhaps through tariffs, perhaps through state support, perhaps through other macroeconomic and political or even tax bases to change the shape of supply chains and reshoring. That said, things like high growth will always have a positive factor. They're always good. I mean, you would always see high growth as something that you definitely want to keep on looking at. So demographics especially will play a large role. So South Asia, Africa will definitely be places where economic activity both on the demand and supply side will see progress much more. That said, and talking about sort of, debt issuance, you will find that long-term patient capital. Possibly, what I mean is the private equity side, family office, non-public capital will become more important because the reliance on people who can actually stay invested in for longer term is possibly going to become even more important. In terms of sectors that I see, I will see that they will be, obviously, as everybody can think about, is investment in healthcare is high. Social care will require quite a lot of investments. The entire case around universal basic income is going to come in as well. And quite a lot of countries are already starting to think about it. They have rolled out some interesting macroeconomic interventions where wages are either guaranteed, or there is helicopter money, or money is given out to households and individuals. So there is definitely going to be an increase in these sectors. Where I think investment and trading will obviously be positive. The financing obviously is a bit of a question mark, and as I was just sort of throwing up my hands when I saw the negative rate situation in the UK. This very large amount of debt financing that the governments are doing is or possibly could mop up liquidity, but we don't know. I think the lack of a reaction from the fixed income markets leads me to believe that I'm not sure that the old prescriptions will still hold true. It may well be that there is sufficient appetite in the world to cater for not just the government debt issuance, but also what the private sector will need. But let's see what will happen. There is a chance that liquidity might be mopped up by the governments, but not quite sure, at all. Then the next thing that I would see is around trade finance will remain constrained. There is quite a lot of activity that I would say is from the regulatory side and from the banking side. It is going to be constrained, and that will mean that the SMEs will be disproportionately impacted, as they do tend to be the most sensitive to bank financing. So that's what I feel, that the small and medium scale enterprises are going to be impacted. As usual with these things, history tells us that protectionism almost always rises, and that will further impact trade. I just read a paper a few days back about how they evaluated the rise in trade frictions and protectionism. And regretfully, what the finding of that from the Great Depression was that because of the rise in trade barriers, it actually contributed much more to the global downturn, 20 to 40%. So whilst me as an economist and possibly an historian might say that it's not the right thing to do, but I'm afraid the default option is to protect and raise barriers, which is not a good idea. Now, I did talk about the demographics before, but what a lot of these countries where the demographics are good, they don't have the fiscal firepower, the monetary ability, or the governance capacity to boost demand. Some of them are better than others, but what a lot of them already have got huge debt burdens. Their tax raising ability is constrained because either they are already highly taxed or their tax infrastructure is not well established, or simply they don't have the governance capability to boost demand, increase productivity, etc., etc. But that's it. That's what we have. You know, as I say, you go to war with the army that you have, not with the army that you want. So you will have to live with this. So I think we just have to be very, very clear-eyed that yes, there is high growth, but there are mitigating circumstances to that as well. Oil price, look, I mean, you know, experts, bigger experts than me have tried to do this, but my feeling is that the oil price will stabilize. The core underlying demand is quite strong, and the alternative sources still have a bit of a way to go before it can replace it properly. So that's definitely going to provide a certain bit of stability to the market. We know about the World Trade Organization. It's getting stressed, sidelined, and irrelevant, which is a shame. I think it's at this particular time, and I do hope people do come around the WTO to make it much more relevant, because it's only when barriers are low, people are playing on a level playing field, and services, goods are being traded much easier, that the entire world will recover. If we start breaking it up into small pieces, then it's going to take longer, and there's going to be much more hurt. So that's a prayer. Let's hope it will get better. And finally, the repairing of the government, corporate, household, and individual balance sheets is going to take long. Debt burden is going to rise. The assets, they are going to deleverage. Earnings will be constrained. So we should keep an eye out on the balance sheets of the four sectors. That's going to be a very, very good reason and a factor to judge how international trade is going to improve. So these are the kind of broad factors that are going to drive international trade. And if I have to use one word, I would say subdued. Over the next 18 months, 24 months, it's going to be subdued, is what my one word prognosis would be. So if that is the case, what would I say to corporates? And here on the left of the slide deck, I have all the various sectors that we have got. You got the primary sector, you got the secondary finished goods, service sectors, and quaternary sectors like the education, public sector, research and development. Obviously, we don't have enough time now to go through all of these in detail. But broadly speaking, cash is king. You have to protect it. I would also encourage people to push for foreign markets, because you have to diversify your markets. If protectionism and breaks are going to happen, then this is the time that you actually go and look at new markets. I know it's a counterintuitive thing, but this is the time for you to explore and diversify your earnings. So this is a good place to be in. Corporate investment, if possible, is a must. And I know I'm talking about saving cash, but But if you start pulling back on corporate investment, I think it's too short-sighted a measure. I think people who want to survive this have to start thinking about ways to make your operations more efficient, explore new markets, come up with new IP, etc., etc. But talking about IP, you need to protect it because of the protectionism and increase in disputes. Expropriation is definitely a factor that you need to consider. So do try and protect your IP in safe jurisdiction. Scenario planning is a must. I mean, the number of companies that I have read about who didn't have a business continuity plan or a disaster plan is legion. So definitely do scenario planning. And that includes taking a look at your people, your staff, your resource pipeline, your talent pool, definitely is very important. A huge number of government stimulus schemes are available. You should take a look at that. And in terms of financing, yes, interest rates are very low, and so definitely take advantage of it, but do take a look at the interest coverage ratios. That can be the sneaky mugger that comes up and gives you a sucker punch at the end. Payment insurance and guarantees can help, although you might quibble at the premium that you might have to pay, but it does help protect your cash flow. Diversification I've already talked about. And finally, digital technology, they're all good, but the way I see it is they haven't been, the entire technology startup segment, they haven't been tested to the extent where you have both a demand and supply shock. So monetization of the technology or customers and cash flow is going to be challenging. So that's the perspective on corporates. If we take a look at it from the financial institution side, obviously the major areas you're talking about asset management, and that's hopefully not going to take that much amount of a hit, but then obviously you'll have to look at the strategies that you're doing, sectors and markets that you're operating in. But I think broadly speaking, yes, people are going to withdraw into cash, possibly into other assets, but it should be okay. Private banking and wealth management, yes, there's going to be a reduction in the rate of growth, but again, they should be relatively good. Corporate banking, transaction banking are going to get affected for obvious reasons. You're talking about corporates who are facing a demand as well as a supply shock. Investment banking, yes, in certain sectors that is going to be impacted, but what people are doing, as in doing cross collaboration, for example, with private banking, wealth management, investment banking, those are good options to look at. FinTech is definitely a place to adopt, and I think if I was in a financial institution, I would look at FinTechs with a fresh eye. This is a great opportunity to re-look at operating models and to simplify your frankly old and archaic methods or business models hugely. So this is one of the places where investment can really pay off. What does that mean? It's all about reducing the cost-income ratio. You have to become lean and mean. So the cost-income ratios are extraordinary, to put it politely. Process times, make it much more efficient, seriously efficient, because that's the one way that you can save time and improve customer satisfaction. Invest in innovation, new products, new markets, I've already talked about. And drop deadwood RWAs. Relook at places where the RWAs are simply not giving you the return that you need. And final thing is, as one of my friends very pithily pointed out, you have to take risks. Financial institutions exist to take risks. They finance risks. You have to go back to the basics of banking and financial intermediation. You have to take risks. You have to finance economic activity. as my friend said, you aren't a regulatory optimization machine. That roughly about brings me to the end of what I wanted to say. To summarize, I think in the beginning part, we went into the global financial crisis on a state of very steady and huge growth in international trade. The global financial crisis crimped that growth, and just when we were starting to come out of it, we got slapped around the face with this large wet fish called as COVID-19. The future over the next 18-24 months is, from an international trade perspective, subdued. But I think this is a good chance for people, whilst protecting their cash, to explore new markets, become more efficient, and try and push forward. So let's now wrap this up and open this up for questions. So Hiba, can I hand it back to you, please?
Absolutely. Thank you for that. That was very enlightening. I think we're ready for questions now. So the first question is from, let's take the first one, from Sartak. Sartak is asking, how do you see the ripples of COVID-19, particularly in Dubai? Current oil and gas situation, low oil prices, and GCC's dependency on oil-centric portfolio, combined with COVID-19, will be difficult to handle.
Good question. I mean, I can but refer you to the recent Dubai Chamber of Commerce survey that was done, and I know that survey was done in April, where things were looking far bleaker than before. But as you can see, that there is a bit of an uptick. The economies have started to open up, and the way I see is open economies do suffer quickly, but they recover quickly as well. That is one thing that open economies are pretty good at. And in this case, I would say the flexible nature of the Dubai economy is going to help out for it to recover pretty well. About the oil price, you have seen the recovery that happened, the blip that we saw a few weeks back was because of more of technical as well as storage issues. So it has come up. My personal opinion, although I'm not an oil economist by any stretch of the imagination, I would say that it should stabilize. And because it is such an important fundamental sector and a commodity in world trade, it is going to come back and it's going to stabilize. So to answer your question, yes, we will. There's definitely going to be a hit, but I think the recovery should be fast as well.
Thank you for that. Next question is from Tamer. Tamer is asking, do you believe that there will be a distinction between developed and developing countries when it comes to their response to international trade, as some of these countries will be following their own self-reliance economy?
So yes, I do believe that that is going to be the case. As I mentioned, there is already signs from the global financial crisis that protectionism is rising. And the developed economies have increased that level of protectionist tendencies, and yes, it is going to increase going forward. In certain cases, you can say it's understandable, like pharmaceuticals, but broadly speaking, I suspect that tendency for developed markets is going to increase. For the emerging markets or lesser developed countries, I think they are going to face a slightly more complicated situation. Countries which are democratic will have to respond to nativist and protectionist calls for for protection, and there is going to be that element of protectionist thinking as well. But then look upon the countervailing factors. They have to trade to earn foreign exchange. All of these, quite a lot of these countries are going for the IMF for help. And one of the key things that the IMF recommends is open economies. So I would say, broadly speaking, the South-South trade or the emerging market trade is going to be there. That is one of the reasons why I'm saying that exploring open markets and emerging markets and new products for these new markets is definitely the place to explore for protection of your cash flow and future business strategy.
What are some of the products that are going to be hype in the new, international trade that is coming up post COVID-19?
So if I can look at the various sectors, the areas that are definitely going to be quite interesting would be, obviously, healthcare is huge. That is going to increase heavily. Because of the change in working conditions, I think the technology side, communications, telecommunications, electronics, those sectors also will be quite good. Things which are not directly related but could definitely benefit would be things around space, further automation, robotics. Agriculture will also be a good place to be in. Sensors. I would also say that people frequently overlook the benefit of intermediate goods. People don't see that. I mean, when we are talking about intermediate goods, you're talking about parts that go into the final thing, final product, and they are not visible. So gears, tappets, plastic parts, things that are intermediate, chemicals. If you are much more efficient, if you are operating on better quality, lower price, higher product turnover, so these are the areas that I think will be going up. But sectors that demand what I would call as consumer demand, that's going to be a bit lower or subdued.
Right. I've seen a lot of emails coming. So which place across the world will be attracting foreign direct investment? Which places?
I wish there was a good answer to that. Look, as I said, places which are going to attract foreign direct investments is a corollary to the sectors that I think are going to be good. So where there is growth, I talked about South Asia, I talked about Africa, there is growth there. So these people are going to require houses, they are going to require better roads, they are going to require refrigerators, they are going to require personal transportation, they are going to require better or more hospitals. Schooling is going to be required, even though they might decide to sort of, they learn from home. But in these emerging markets, you don't have internet connectivity. So a personal delivery of education and services is still going to be there. So when you're talking about foreign direct investment, it will tend to go to places where there is demand. So emerging markets is definitely the place where I would say that you would see the growth in FDI going over there. But that said, let's not forget the developed markets as well. If you look at some of the markets which are like the US or Europe, there is huge internal markets as well, and people do have discretionary spend. So in terms of, are we going to see a significant shift in FDI? I don't think so. The quantum might reduce, but the pattern will remain the same.
Right. So my next question is from John, and John is asking, what is the future for Dubai as a regional and global center for talent, and will it maintain its leadership?
I think so. I definitely think so. I mean, I go back to what I said before. Open economies and good ecosystems. And if you look at, and let me try and answer it from the perspective of not just Dubai, but the perspective of UAE. It's a good place to be in. It's a good place to be here. It's a very safe place. It's a happy place. Lots of good restaurants, which is a good reason to be there.
Not at the moment, but in the future, yes,
Yes.
and in the past.
The infrastructure is good. Then you have got great facilities. The roads are very good. The availability of consumer goods is there. When you're looking at political risk or country risk factors, it's pretty good. Let me give you another example. I was just writing a book chapter, and one of the things that I was looking at are the risks of operating in this part of the world. And quite a lot of people have said, "Oh, the Middle East, it's you know, we're going to have a challenge." And I keep on saying, actually, no. Think about it. What we're talking about corruption. If you look at Transparency International, the UAE is currently rated higher than France and US. So if you're talking about the UAE as being a good place to work in, it has got all the right things going for it. So if you're looking at the region, the wider region, whether you're talking about Central Asia, GCC, Africa, South Asia, North Africa, if you wanted to set up a business, and this is the place to be in. And geographically, it's placed beautifully between China and Africa, between the West and the East. It has got very good legal systems. It's digital, it's fast, it's efficient. People trust the governance structures. So I think this is a great place to do business.
Agree with you. Another question from Muzammil. Muzammil is asking, are there an increase in healthcare investment, as there is an increase in healthcare investment in the Gulf? Do you think that there will be a drastic decrease in capital investment projects in the Gulf region, and especially in Saudi?
No, I don't think so. Because if you're talking about the infrastructure investments, those will, well, yes, it may be delayed. But I think the infrastructure investment will go on. But insofar as there are two things to consider in the GCC. First is the healthcare systems are already pretty good. They are pretty good, and if you look at the various surveys of healthcare sector that have occurred, the GCC countries have got pretty good. I mean, if you look at the health tourism in, for example, the UAE, it's pretty high on the list. So people do travel over here. But yes, there's going to be more attention and additional investment that's going to go into healthcare. Is it going to be at the cost of other infrastructure investments? I don't think so. I don't think so. This is the additional investment. But then this thing is going to happen across the world. There might be a slight delay or reduction in essential infrastructure investment, but my suspicion is that healthcare investment is going to be over and above. And when I say healthcare, I'm talking broad healthcare. I'm including nursing homes, I'm talking about social care, I'm talking about mental health, I'm talking about hospitals, pharmaceuticals, pharmacy, delivery, sensors, testing. That entire thing is going to expand, and much additional capital is going to flow in.
Thank you for that. Another question from Sartak. He's asking, how should startups and young businesses survive in this environment? We're just talking about this.
So, look, many of the regions factors that I already mentioned on the corporate side do apply to startups, but at the end of the day, startups are young and they are going to get disproportionately impacted by this. First, as I keep on saying, try and diversify your sources of revenues. At the end of the day, you have to rethink where are you going to earn the money from. Yes, there is a huge amount of venture capital, early stage, and of course, PE funds available, but it's not a open faucet that you can keep on drawing down. People are going to rethink the business models. They're going to ask you, how are you going to monetize your business model? Where are the earnings going to come from, et cetera, et cetera. So I would say the first thing would be is to see whether you can diversify your personal sources of income as a startup founder. That's the first thing. The second thing, as I mentioned, is another factor is the private capital. Try and go for places where you do have long-term patient capital and government schemes, because they don't usually get affected by commercial decisions that open. At the risk of trying to plug my own shop, we do have those kind of schemes available for investments in startups which are longer term in nature. There are incentivization schemes that can reduce or significantly stop your cash outflows. But yeah, it's not going to be easy, but those are the 3-4 things I would say startups can do.
Thank you for that. Tariq is asking, do you think it's a good time to invest in tech platforms like FinTech projects and blockchain?
Tough question. I don't think I can answer that well. Personally speaking, I think it's a bit too early. I think I would wait for some more time for the dust to settle. But it depends upon your risk appetite. Let's put it in this way: when the downturn happened, I went back into the market, but then I had some cash. And for the right opportunity, I will invest in it. So, but broadly speaking, to answer your question, and I'm trying to generalize wildly over here, so you have to apologize. I think I would wait before plunging into that end of the investment opportunity.
Right. I think we have a few minutes, so is it okay to take just a couple of questions?
Sure, please go ahead.
Right. Okay. So Salah is asking, can you please tell us or advise us as individuals, all of us, how can we change our habits so we can come out of this with the least losses? So what's the advice that you would give us to, minimize our losses or reduce them?
So I think I don't have any magic words and silver bullets over here, but the things that I would do, or what I have told my cost centers as well, and thankfully I think they have taken this on board, is to try and make sure that you reduce your spend, because that is under your control. That is the main thing that is under your control. So given the uncertainty, do try and reduce your spend and increase your savings. And that is what is happening. If you look at the savings rate in the US or Europe or wherever the stats have been released, they have, in certain cases, nearly doubled. So people will save cash. But then on the flip side, I would also say is that keep an eye out for opportunities, because it's at this point in time that perhaps a contrarian view can help. If you see that good value companies are being significantly undervalued or oversold, And if you have got cash, then definitely that is a place for you to explore going back in. The last thing that I would again advise is this is not the time to hunker down. This is not the time to raise walls and shut up and sort of, oh, the sky is falling on my head. So, oh my God, I don't know what to do, so I'm not going to do anything. This is not the time to do that. This is the time to read more. This is the time to look at more opportunities. This is the time to diversify your earnings and income. Think about something, start blogging, start writing, be an influencer. I don't know, whatever that means, but try and diversify your sources of income. Test it out. This is the time that that there are more opportunities, and you will be lucky because you are jumping at more opportunities. So that's what I would say. I know these are very anodyne things, but there we go. That's all.
They're very helpful. And with your advice, I would like to end the session because it's just turned 6. So thank you all for attending. Thank you, Dr. Bhaskar. That was a very insightful session. And I really apologize for the so many questions that I haven't been able to go over. But, maybe if once we share the recording again, you would be able to get a few insights and it will answer your questions. Dr. Bhaskar is also available on LinkedIn, so if you would like to connect with him, he's more than happy to do that. So anything that you would like to add, Dr. Bhaskar?
No, thank you. It was a pleasure speaking to you, and thank you ever so much for taking the time out on a Thursday evening, especially for folks in the Middle East. I know the weekend has started. So thank you very much, and hope that was of benefit, and I hope you have a great weekend.
Thank you so much. Thank you, Dr. Bhaskar. We hope you have a great weekend too. Thank you everyone for signing up and for attending our webinar today. The recording will be shared, as I said, with all of you tomorrow. You will be receiving it in an email. And also stay tuned to our future webinars. These are available on our website, so just visit the website of the university, www.manchester.ae, and go to the events section. You will be able to get an overview of all the webinars that we are running. Feel free to register. We are sharing our webinars with the entire community. So just feel free also to share them with anyone that you think would be interested. Thank you again, everyone. Have a lovely weekend, and we'll see you soon on the June 1st and June 3rd as we have our upcoming webinars. So thank you, Dr. Bhaskar. It's always a pleasure to have you, and I look forward to having you again on a face-to-face session.
Great. Thank you. Cheers.
Bye-bye. Good evening, everyone. Have a lovely weekend. Goodbye.